Ever seen a poker player win big one night, then lose it all the next? That's what happens when traders rely on a single backtest. They think they've found an edge, but in reality, it's just one lucky hand. The only way to know if your strategy has staying power is to shuffle the deck and play it again and again. That's what Monte Carlo testing does. In this video, I will explain the Monte Carlo tests. So, what exactly is a Monte Carlo test? Think of it like testing a bridge. When engineers build a bridge, they don't just check if cars can drive across it on a sunny day. They test it against wind, earthquakes, heavy trucks, things that might break it. Monte Carlo is the same idea, but for your trading system. Instead of one single backtest result, Monte Carlo creates many different versions of your strategy. It scrambles trades, adds slippage, tweaks parameters, and even shifts the start date of the test. Each simulation is a what-if scenario, and the goal is to see, does your strategy stay strong, or does it collapse the moment conditions change? In StrategyQuant X, Monte Carlo testing is built right into the platform, and it works in two main ways. The first is called trade manipulation. This one is quick because it doesn't rerun the whole backtest, it just plays with the order of your trades. For example, imagine you had 100 trades in your backtest. The original order might look smooth, with small drawdowns. But what if those trades happened in a different sequence? Monte Carlo shuffles them around, and suddenly you might see a much bigger drawdown. That tells you something important. Maybe your strategy's smooth equity curve was just luck in the order of trades. There are other tricks here too. You can simulate skipped trades like missing a signal because of internet loss or platform issues. Or resample trades where some trades get picked multiple times and others are skipped. Each simulation creates a new equity curve and a new set of results. Here's how you use it. Let's say your original backtest shows $3,866 profit. After Monte Carlo, at the 95% confidence level, it says $2,826 profit. That means there's a 5% chance your strategy makes less than $2,826 profit in real conditions. Not so perfect anymore, is it? That's the reality check traders need. The second type of Monte Carlo test in StrategyQuant X goes deeper. It's called retest methods. These don't just shuffle trades, they rerun the full backtest, but with little twists. For example, randomize your strategy's parameters, like moving an indicator from 60 to 58 or 62. 10% probability means if you did something 10 times, it would happen only once. Change in percent is just how much something went up or down compared to where it started. Slightly change the historical data, just enough to see if your system is too sensitive. Shift the starting bar because a robust system shouldn't depend on where the test begins. Or add random slippage and spread, since in live trading, costs are never fixed. This is more demanding for your computer, but it's powerful, because if your system only works with one perfect set of conditions, that's not a strategy it's overfitting. And Monte Carlo exposes that weakness. So, what about the number of simulations? Think of it like this. Making one lucky basketball shot doesn't make you a pro. You need to take hundreds of shots to prove it wasn't a fluke. Each shot is one simulation for your strategy. Running just a few tests is like relying on a lucky bounce. But running hundreds? That proves your strategy is a true all-star. Here's the magic number. Test your strategy with at least 200 simulations. Why 200? It's like watching a player take 200 shots. You'll know if they're consistently good or just got lucky a few times. Less than that? You might be fooled by a hot streak. More than that? You're wasting time. You already know they can play. This test can take a lot of PC resources, so if you have a lot of strategies, you can start with smaller numbers like 30 or 50, and then increase to 200 to 500 once you have a few final strategies. 200 or 500 simulations give you the real confidence that your strategy can perform consistently, not just in that one perfect backtest. Don't trust one lucky shot, trust the average of many. Now, let's talk about the results. Monte Carlo doesn't give you one number, it gives you a range. It shows the best case, the worst case, and everything in between. And it attaches confidence levels to those numbers. For example, at the 95% confidence level, it's saying there's only a 5% chance your results will be worse than this. That's a much more realistic way to plan capital and risk, because it's not just what happened in the past. It's what's likely to happen in the future, even if things go wrong. And here's the best part. In StrategyQuant X, you can even set filters like reject any strategy that loses more than 50% return drawdown ratio under Monte Carlo simulation. That way, weak strategies never even make it to your portfolio. So, to wrap it up, Monte Carlo testing is your strategy stress test. It tells you if your edge is real or just a lucky backdust. It shows you how much your results can change under real-life messiness like missed trades, bad fills, and shifting spreads. And it gives you confidence levels, so you know exactly what risk you're taking. In short, Monte Carlo keeps you from fooling yourself. Because in trading, it's not the best-looking strategy that survives. It's the most robust one. Share with us your favorite robustness test, or which topic would you like to see in the next videos in the comments. If you like this video, please like, share, and hit the notification to make sure that you will not miss any future content. Thank you for watching, and see you in another video.